Good morning, my dear students. Good morning, one and all. Welcome to the another session. The topic name is Case Studies and Big Data for Finance. We need to talk in this specific lecture model. So, leveraging big data that's transforming risk management in the banking sector. We need to talk in this specific lecture mode. In today's data-driven world, the financial industry is continuously exploring innovative ways to harness the power of big data to enhance the decision-making processes, particularly in the realm of risk management. With the exponential growth of data sources and the increasing complexities of financial markets, traditional risk management approaches are proving to be inadequate. So in response, banks and financial institutions are turning to big data analytics to gain a deeper insights into risk and improve regulatory compliance and fortify risk governance frameworks too. Okay, let's delve into the compelling case study that exemplifies the successful application of big data in risk management within the banking sector. The first case study, risk management in the banking sector. It's analyzing a successful applications of big data in risk management. And one prominent example of big data transforming risk management in banking is the utilization of advanced analytics techniques to assess the credit risk. Traditionally, we can say banks relied on a limited data sets and static model to evaluate the creditworthiness of borrowers. However, with the advent of big data technologies, financial institutions can now leverage the vast volume of structured and unstructured data from diverse sources such as transaction records, social media, and market data. So, by employing machine learning algorithms and predictive analytics, banks they can analyze the historical transactions data to identify the patterns and detect anomalies indicative of potential credit defaults. So these sophisticated models it enable lenders to make a more accurate risk assessments, thereby minimizing credit losses and improving portfolio performance too. And furthermore, we can say big data analytics that facilitates a real-time monitoring of market conditions and macroeconomic indicators, that's allowing banks to promptly adjust risk mitigation strategies in response to emerging threats or opportunities. By harnessing the power of big data, financial institutions they can enhance their ability to anticipate and manage various types of risk, including a credit, market, and operational risk. Okay, the next will be on regulatory compliance and risk governance considerations. We need to talk some of the levels and points. In addition to enhancing risk assessment capabilities, big data it plays a pivotal role in regulatory compliance and risk governance within the banking sector. With the implementation of stringent regulatory frameworks such as Basel III and the Dodd-Frank Act, finance institutions are under increased pressure to demonstrate robust risk management practices and ensure a compliance with regulatory requirements. As well as big data analytics, it enables banks to aggregate and analyze vast volumes of data to monitor and report on key risk metrics in real time. By integrating disparate data sources and leveraging advanced analytics tools, banks they can enhance the transparency, accuracy, and timeliness in regulatory reporting, thereby mitigating compliance risk and avoiding regulatory penalties. Moreover, big data facilitates the implementation of comprehensive risk governance frameworks by providing stakeholders with actionable insights into risk exposure and control effectiveness. By establishing a data-driven risk culture, banks they can foster greater collaboration and alignment across the business units. It's enabling more informed decision making and proactive risk management too. So in a nutshell, we can say the case study highlights the transformative impact of big data on risk management within the banking sector. By harnessing advanced analytics and leveraging vast data sources, financial institutions they can enhance the risk assessment capabilities, improve regulatory compliance, and strengthen the risk governance frameworks, everything. As the financial landscape continues to evolve, the adoption of big data technologies that will be essential for banks to remain competitive and resilient in an increasingly complex and dynamic environment. So stay tuned for more insightful case studies that exploring the intersection of big data and finance, my dear students. Okay, the next is we need to talk about the case studies in big data for finance, that is customer segmentation and retail finance. We need to talk now. The realm of finance where understanding a consumer behavior is paramount. So big data analytics has emerged as a game changer. By delving deep into vast pools of data, financial institutions they can unlock valuable insights into customer preferences, behaviors, and needs. One such applications of big data analytics is customer segmentation, particularly in the retail finance sector, we can say. So in this type of case study, we will explore how big data transformed customer targeting strategies and evaluate its impact on sales and customer satisfaction. Okay, the first point we need to talk about examining how big data transformed the customer targeting strategies. Traditionally, we can say customer segmentation in retail finance, it relied on a broad demographics and a basic transactional data. However, this approach it's often overlooked nuances in customer behavior and preferences. It's leading to generalized marketing strategies and suboptimal results too. So we need to enter a big data analytics, and by harnessing the power of advanced analytics tools and techniques, finance institutions they can now analyze the vast amounts, that is vast volumes of a structured and unstructured data in real time. For instance, we can say through the integration of a transactional data, social media activity, browsing history, and even sensor data from wearable devices, banks and retail finance companies can create a detailed profiles of individual customers. And these profiles go beyond a simple demographics to include insights into purchasing habits, lifestyle preferences, life events, and much more options are available. So armed with this rich data set, financial institutions they can segment customers into micro-targeted groups that's based on a shared characteristics and behaviors. Rather than treating all customers alike, personalized marketing campaigns, this process can be crafted to resonate with each segment's unique needs and preferences. Whether it's offering a tailored product recommendations, personalized promotions, or targeted messaging, big data it enables retail finance companies to engage with the customer on a more intimate level. Understand? So second point, we need to talk about the assessing the impact on a sales and the customer satisfaction. We have to talk some other discussion level. So the impact of leveraging big data for customer segmentation in retail finance that extends far beyond improved targeting strategies. It directly translates into tangible business outcomes by delivering personalized experiences and offers. Financial institutions they can drive a customer segment, loyalty, and ultimately we can say sales. Exactly. Like a various number of studies have shown that a personalized marketing campaigns that's result in significantly higher conversion rates that's compared to generic mass marketing efforts. When customers receive offers that align with their interests and needs, they are more likely to respond positively. It's leading to increased sales and revenue for the financial institution. Moreover, personalized experiences it foster a strong relationship that's between customers and their financial service providers. It's leading to higher levels of satisfaction and loyalty. So, by demonstrating a deep understanding of their customers' needs and preferences, finance institutions they can position themselves as a trusted advisors. It's enhancing a brand reputation and fostering a long-term customer relationships we can create. So in a nutshell, we can say the case study of a customer segmentation and retail finance that illustrates the transformative power of big data analytics in the financial sector. By moving beyond the traditional segmentation methods and leveraging the wealth of data at their disposal, finance institutions they can revolutionize their customer targeting strategies, driving sales and enhancing a customer satisfaction in the process. So a big data continues to evolve. We can say it's a potential to reshape the landscape of retail finance that remains immense, promising even greater opportunities for innovation and growth in the years to come, my dear students. Next part we need to discuss about the unveiling the power of big data in finance. What are the case studies in a fraud detection we need to talk now. In today's digital age, the finance industry that grapples with the omnipresent threat of fraud. As financial transactions become increasingly complex and connections, traditional methods of fraud detection it often fall short in safeguarding against sophisticated fraudulent activities. So we have to enter a big data analytics, and actually it's a game changer in the fight against financial fraud. And in this part of our case study series on big data in finance, we delve into real world examples of how big data is revolutionizing fraud detection in financial transactions. The case study third will be on fraud detection in financial transactions. We need to talk, that is real world examples of a fraud detection systems that utilizing a big data we need to talk now. In recent years, finance institutions have been leveraging big data analytics to fortify their fraud detection capabilities. One such example is the use of machine learning algorithms to analyze vast amounts of transactional data in real time. By identifying patterns and anomalies that's indicative of a fraudulent behavior, and these systems can flag a suspicious activities for further investigation. So we have to take the case of leading global bank that implemented a sophisticated fraud detection system that's powered by big data analytics. By integrating data from multiple sources such as transaction records, customer profiles, and external databases, the bank it was able to create a comprehensive view of each customer's financial behavior, and machine learning models that are trained on this data continuously monitor transactions for irregularities. It's enabling the bank to swiftly identify and mitigate the fraudulent activities. And another compelling example, it comes from this insurance industry, where big data analytics is being utilized to combat insurance fraud. So insurers are employing advanced analytics techniques to scrutinize vast data sets. It's comprising policyholder information, claims history, and external data sources. So by applying predictive modeling and anomaly detection algorithms, insurers they can detect fraudulent claims with remarkable accuracy. It's saving billions of dollars annually. Understand? So another point we need to discuss about the evaluating the effectiveness and efficiency of fraud prevention measures. We need to talk some other levels, then we'll go for a conclusion mode. While adoption of a big data analytics holds immense promise for a fraud detection, and its effectiveness hinges on several factors including data quality, algorithm accuracy, and operational efficiency, everything. That's why the finance institutions must continue to evaluate and refine their fraud prevention measures to stay ahead of evolving threats. One crucial aspect of evaluating fraud prevention measures is assessing the false positive rate, and the rate at which legitimate transactions are mistakenly flagged as fraudulent. And high false positive rates not only inconvenience customers but also strain resources, as investigators must shift through a large number of false alerts. By fine-tuning algorithms and incorporating feedback mechanisms, organizations and businesses and financial institutions they can minimize the false positives while maintaining a robust fraud detection capabilities. And furthermore, we can focus the scalability and agility of fraud detection systems are paramount given the dynamic nature of financial fraud. As transaction volumes soar and fraud schemes evolve, organizations must ensure that their analytics infrastructure can scale seamlessly to accommodate growing data volumes and adapt quickly to emerging threats now. So in a final conclusion, we can focus big data analytics. It presents unparalleled opportunities for enhancing fraud detection and financial transactions. By harnessing the power of advanced analytics and machine learning, organizations they can practically identify and mitigate fraudulent activities, safeguarding their assets and boosting customer trust. Everything we have to focus much more. However, success in fraud prevention it requires a holistic approach that encompassing data integration, algorithmic refinement, and operational excellence. Everything we have to concentrate. As the finance industry continues to embrace the possibilities of big data, the fight against the financial fraud that enters a new era of innovation and resilience. Okay, stay tuned for more insights on the transformative role of big data and finance. Okay, my dear students, I hope you have enjoyed another session of the topic of case studies in big data for finance. Thank you once again, and thank you all my dear students.